Have you ever wanted to learn about alternative investments? Things that are outside your widely publicized stock and bond market funds. We have an exciting interview with Christopher Zook, the CIO of CAZ Investments. CAZ is an asset manager that focuses on sourcing complex and thematic opportunities for its owners, investors, and also investment partners. What does that mean? CAZ brings access to owning professional sports teams, owning GP stakes in some of the largest private equity funds in the world, disruptive technology companies, private credit opportunities, shorting markets, and many more. CAZ has the track record to back it up and actually reviews over 1,500 opportunities per year, and they typically invest in less than 10 of them. CAZ is also widely known as one of the largest investors in the world in minority stakes in private market investment firms. I've had the chance to meet Christopher and his team in person, and transparently, I'm an investor in one of the CAZ investment funds. You're going to want to listen to this entire interview. Thanks. Hey everyone, welcome to the podcast where we bring on thought leaders to share valuable insights to help you become a better investor and explain what's going on in the industry. We have on the CIO of CAZ Investments, Christopher Zook, and maybe Christopher, if you can give a background about yourself and just we can go from there.
Sure. Been in Texas my entire life, been based in Houston, and started the firm 21 years ago with the backing of some very significant families in the Houston and Texas area. And love the investment world, been involved in it since basically I was in college, helped put myself through school trading commodity futures. And so just really enjoy the industry and love being a part of it. And specifically alternative investments is our primary focus. And that's just really what my passion is.
Awesome. Well, Chris, I'm sure you've seen quite a bit over your career, and maybe can you explain what are alternative investments?
So it's such a broad category. I mean, it's like saying, what's a mutual fund, right? And the answer is it can be almost anything you want it to be. So literally an alternative investment could be anything from a private equity fund where you're buying companies, improving them, hopefully, and then selling them, to a private credit fund where you're making loans to private businesses and not having anything that is freely tradable, to private real estate. It's funny because most everyone in the audience, or at least a large percentage of them, have a home. Well, technically you're in the alternative investment when you own a piece of real estate that is your home. It could be venture capital. It could be cryptocurrencies. It could be all the other things that are not mainstream. And that's where the term alternative comes from, is there alternatives to what is normally available. That would be buying Apple, buying Amazon, buying IBM, whatever the case might be. If you're investing in the public markets, it's typically referred to as the public investments. And if you're in the private markets, it's going to be called either private investments or the alternative investment platform. And that is what alternative investments are to most people. But they could be literally as eccentric as buying, we own a firm that they specialize in buying royalties on music. So they own a big chunk of Taylor Swift's, music library. You have alternative investments that could do everything from art and own some of the most iconic art pieces in the world. And then you can literally have alternative investments would be just, buying a restaurant and owning a restaurant in whatever city that you have it. So it really is a catch-all category, kind of like mutual funds are. But generally speaking, in the alternative investment world, you're thinking about hedge funds, private equity, venture capital, real estate, real assets, oil and gas, anything that would be referred to as infrastructure, those kinds of things is what typically alternative investments would fall into the bucket of in most people's minds.
That's great. And so the Super Bowl just happened, and I'm sure people would think, wow, wouldn't it be great if you can one day own a sports team, right? Which is an investment that most and generally do not have access to. And so maybe break it down in terms of like owning a sports team and using that as an investment vehicle, as an alternative asset, and how it relates to you.
It talks a little bit about how we think while I answer your question. We're very thematic as an organization. And so we really try to find a big theme that we can take advantage of. And there's really not many people on this planet that would disagree with the statement that cord cutting has accelerated and is likely to continue.
Mhm.
And so if you think about cord cutting as a theme, it has a ripple effect. That ripple effect is that advertisers have a real tough time reaching their audience. They can advertise to us via social media or the internet with a rifle and specifically target us for their advertisement, but that's not very scalable, because in the old days as in like a couple of years ago, old days, they literally could just advertise at a live event and reach a whole lot of eyeballs in one place at one time. Well, I believe it was 1991, out of the top 100 most watched events on television, 92 of them were not sports.
Wow.
8 of them were sports. Last year, 21, I won't have 22 data yet. In 21, 92 out of 100 were sports. So it has shifted so dramatically, because my guess is you are like me. You watch Amazon Prime, you watch Netflix, you do other things, and you do not watch a commercial unless somebody literally ties you to the chair. So in the Super Bowl's case, you probably watched a lot of commercials. And so that's why their fee, the expense to buy a Super Bowl commercial slot is so amazingly high. So if you own the team, if you
Wow.
own a piece of the league itself, then you actually get to benefit from all of that rush of advertisers to reach the only audience they can, which is live events, most of which, vast majority of which, are obviously professional sports teams. So we own over 25 different teams in professional sports. Everything from our hometown Astros, which obviously won the World Series. We own a piece of the Warriors, which obviously won their national championship. We own a piece of the Tampa Bay Lightning, which was runner up. We had a really, really good season, if you will, but we own a whole bunch of other teams. Fenway Sports Group, we own a piece of Liverpool. We own a lot of different, assets in professional sports, and they're just really not trophy assets, pun intended, to just have something that's really, really cool to own. It is cool to own them, but it's really all about the return that we expect to get and the inflation protection that they bring, et cetera. So yes, it's really hard for people to be able to do that, but with the right access point and as part of the right network, you can absolutely, own a piece of those teams.
And that's fascinating in the world of alternative investments, and even with technology, and the fact that if you think about the Kansas City Chiefs, it was typically owned by, right, as a single person.
Mhm.
And then now the ability to really syndicate that out and give people access to it. And I'm sure it must be just well received in terms of that ability.
It is. The NFL has not yet allowed outside investors in. And so the Hunt family,
Mm.
particularly, they have owned the Chiefs for decades and decades and decades, and they likely will. But there's a big article actually last couple of days talking about how, with the valuations getting so high, it's only a matter of time before most likely the NFL will open up institutional investors to
Mm.
the NFL. But when you start talking about the NBA, the Major League Baseball, the hockey and soccer, European football, there's a lot of other assets out there. The NFL will be, I think, the next one where that occurs, and we will be definitely involved if that happens. But it's a really unique way to take advantage of a trend that is very irrefutable. The other one that's also irrefutable, that's part of it, is sports betting. Most people do not, expect sports betting to start actually going away. They would expect more and more states to actually be in a position to approve it. And all of that is really good for, if you own a sports team in a particular state where that's been approved. It drives fan engagement, it drives revenue, it drives advertising, it drives a lot of different things, all of which benefit you, as the owner. And it's still a very, very small group of people that get to be in that position to own a professional sports team. But this certainly is an area that we have focused on because we believe it's a decade to 2 decade or even longer trend that we want to be a part of.
Wow, that's incredible. And just in terms of, finding these great investments and even these themes, like what is your process, as CIO, and just kind of understanding like the opportunity?
There's a lot of science involved, but there's
Mhm.
also art that's involved. One of the things that we've done successfully over a long period of time is being able to separate ourselves from the emotion of the decision. And if there's one thing that I would say to your audience, that if they don't hear anything else, they should take this away. When emotion is driving an investment decision, it's almost always a bad decision. And anyone who got caught in the crypto, hype, or the meme stock hype, or those kinds of things, and made emotional decisions as part of that, they almost all got burned. If they were disciplined about it, if they were practical about it, and they did their homework, etc., they might have done really well, and they might have been able to, benefit from that trend, which was a definitive theme and trend for a while, but it was based on, a supply demand issue, not necessarily a persistent long-term theme. But if emotion is removed from the equation, one can separate the wheat from the chaff, if you will. We have a saying as a firm, see the forest, not the trees. And for so many people, like in the SPAC heyday, as an example, all they could see was just the easy money is being made by people. And oh my gosh, this is going to go up. And, then we can buy options on it, buy calls, and it's going to drive it up even more. And we can really, take advantage of the way that the market is just positioned at that point. That's rarely a successful outcome. So finding kind of long-term trends that are going to be persistent for a long time is much, much easier. Whether you talk to Mr. Buffett or you talk to any of the other best investors of all time, most people will agree with what the major trends are. How they take advantage of it is certainly going to be, open for debate. But there are also times when everybody in the world knows something's going to happen. They just don't want to admit it. So when we shorted subprime mortgages with John Paulson, pretty much everybody knew that bubble was going to burst. Same thing like the tech bubble in 1999. Pretty much everybody knew this is not going to continue. And they just were not willing to admit it, or they didn't want it to happen. So they rationalized their position. There's an adage that I quote a lot, which is, hope is not a good investment strategy. Desire is not a good investment strategy either. If we want something to occur, it's rarely going to occur in the investment world, at least. So if we can separate our emotion from the decision and look at it with a truly unbiased, I really couldn't care less attitude, I'll buy whatever makes sense. Then people can make a good decision based on good fact pattern, based on good homework that ultimately should, and certainly won't always, but should generate a good result and a good outcome. Once we decide on a theme that we're going to take advantage of, then we're going to try to find the best risk reward. And we have a saying that literally is the first, second, and third question in every single investment committee discussion on an investment. What is the worst case scenario? How does somebody, hurt us? How does somebody do us wrong? Let's you interpret that. The way that people something could happen that we just couldn't expect. And if we can live with the worst case scenario, whatever that may be, the upside will take care of itself. When we invested, as an example, in Icon, the 3D printed home company based in Austin, we were seed investors in the business. We literally knew the worst case scenario was zero. We didn't think it was going to happen. Obviously, we made the investment, but we knew that was possible. And so sometimes we are willing to take that worst case scenario because we knew that if we could live with it and we sized it properly, then the upside would take care of itself. Meaning we really believed that we might just change the world in the way that homes are being built, the way that you could deal with a lot of the homeless issues around the country and around the world. You literally could solve for a lot of things if Icon can get it and make it happen, which they are, and wildly successful. And we're very proud of that investment. But we knew going into it that zero was a possibility, and we would not have made the investment if we were not comfortable with that. And so once we identify the best risk reward, wherever that may be, and sometimes it is zero to a lot, most of the time we're able to have a lot less downside, then what we do is try to find the very best at that area. So in professional sports, we have a partner that's all they do. It's all they think about. In the world of owning private equity, private credit firms themselves, our partners, that's what they specialize in every single day. In the energy markets, in the secondary markets, and other markets, we want to be invested alongside and partner with people that is their passion, that's what their skill set is, and they have an information advantage. And so from there, then we're going to build strategic partnerships to be able to do these things together. And that's kind of the investment process, the CAZ way, if you will, from start to finish.
That's great. A lot of learning lessons there, and yeah, timeless insight. So, you mentioned like sizing it properly, and just curious in terms of how family offices and even just high net worth individuals should think or currently thinking about managing their wealth to have that downside protection, but also just portfolio allocation and just fitting in alternative assets. Do you have any insights there?
There's an old saying that if you've seen one family office, you've seen one family office. They're all very, very different. And it is something to where it really depends on that particular family. The main driver, and this would be true for, professional investors, high net worth investors, family offices. The number one driver typically is what is their need for two things. Number one, what is their need for liquidity, right?
Mm.
That's going to drive a lot of the decision. How much liquidity can they afford to not have, right? How much do they really need? I'll come back to that in a second. The second is going to be how much cash flow do they need? That will drive
Mm.
so much of their allocation decision based on what their cash flow needs are in their particular situation. So, good example is there's a lot of people that have increased their alternative allocations
Mm.
because they recognize they don't need as much liquidity as they originally thought. I had a conversation with somebody, this was a couple of years ago. They had $100 million literally in cash and very, overnight, one day liquidity securities. And I'm just having a conversation with him and I said, I understand that you have 100 million in cash and I get it. We're basically totally 100% liquid securities, had some stocks and some bonds, but something he literally could turn into cash the next day. I said, I understand that. And I know that you're risk averse as to having too much illiquidity, but so let's just role play with me. Is there any scenario that you can imagine that tomorrow, literally within 3 business days, you would need $99 million? Any possible realm that you would need to get access to $99 million in 3 days? No. How about 50 million? No. I said, you may decide to buy a small island in the Caribbean and you need to close on it, but that's still going to take 60, 90, 100 days, right? Yes. You might buy a plane, but that's probably 4 or 5 months, right? Yes. Okay. So why do we need $100 million in something that's totally 100% liquid? And he goes, I really don't. I said, okay, how much would you say I really would want to be able to, within 3 business days, be able to put my hand on? He thought about it for a second. He says, $20 million. I said, okay. So that means you can have 80% of your portfolio in alternative investments and 20 million in the traditional markets. And he goes, yeah, I probably could, but I never would. And I said, I wouldn't expect you to, nor should you. But it wouldn't be a bad idea to have 5% or 10% or 30%, because you'd still have $70 million you'd have access to. And he goes, you're right. So we progressed from there and came up with a solution that made sense. But in most people's cases, their liquidity is vastly overestimated. And to be very clear, nobody wants to get to where they don't have the liquidity they need or make commitments that they can't honor. That's a really bad problem. But most people go way too far the other extreme. The cash flow is pretty easy because, ultimately, you could different places to get cash flow. If your cash flow needs are really, really high, you're going to have kind of handcuffs on you as to what you can and cannot do. If your cash flow, you're getting plenty from your income or from other sources, well, then you can do whatever you want with your portfolio. But generally speaking, most very large families, wealthy families, and even, semi-wealthy families are going to want to have some kind of a barbell approach. We talk about this a lot, where there's some portion of the portfolio that's very safe, highly predictable, usually going to generate some cash flow for you. And it's going to be there if you need it. It's not really subject to the whims of the overall stock market. You're going to probably have a bunch of stuff that you really want to do that's smart, that's sophisticated, that's not correlated, things that are really going to do well and have outsized return opportunities. They will, but at least they have the chance to do so. And then in the middle, kind of mom, apple pie, and, and baseball. Right. So that's going to be public stocks, small cap, mid cap, international, that kind of thing. And that middle section ends up being usually smaller for the bigger the family is, because they've got so much here and they got a little bit in the middle. It looks like a barbell. Well, the smaller somebody's net worth is, Generally speaking, it looks more like the traditional pie that people see, but the bigger the family, they typically are much more of a barbell. And the math on it's not hard. In this interest rate environment, rates have come up a little bit. So I'll just use that as a simple, starting point. If you had on this side of the barbell, the really safe side, call it half your portfolio, just to keep my math simple. Half your portfolio is over here, you're going to make 6. And you go, that's not a great return, but it's okay. And it's safe. And then you take 5% or 50% of your portfolio and you put it over here, and you really believe that you're going to make 12 and have no correlation to the overall market, generally speaking. Well, if you have 50% at 12 and 50% at 6, you're going to end up with an 8% return if those numbers hold true, and you're going to have virtually no correlation to the stock market. So whether the market goes up or down because of GDP this, or jobs report does that, or Federal Reserve this, you really don't have the stress of that. You end up with an 8% rate of return with a very smooth ride. Now, some people like a roller coaster just for the sake of a roller coaster. Most investors don't. Most investors would rather have the smoothest path to get them to their goals and objectives that they have on the other side. And so that's really, I think, where more and more families should be focused, and I think a lot of them already are, is really thinking about how much volatility do I want in order to achieve my objectives and my returns.
Nice. Christopher, so most people, and even just think of their portfolio in terms of stocks and bonds. And the third asset class, which most people do not have access to, which has historically performed, say the S&P 500, would be private equity. And so maybe can you break down private equity in general, how it works, exposure, getting access, and kind of, high level?
Sure. So access is hard because it's almost always limited to certain criteria of investors. There's 3 criteria according to the Securities and Exchange Commission. There's accredited investors, there are what's called qualified clients, and there's qualified purchasers. And a simple, Chat GPT or Google search, whatever, people can look up what those criteria are. But at the qualified purchaser level, you have pretty much access to everything, but that requires an individual to have a $5 million investment portfolio. Well, that's a big number. And so if somebody doesn't have that, they cannot get to what are called QP only vehicles. If they're an accredited investor, which can be met by either an income test or a net worth test, so high, young person making good money, but they don't have that much saved yet, they can still qualify as an accredited investor and do a lot of alternatives. Not everything, but a good portion of that. So private equity is almost always in the qualified purchaser bucket, but there are a few ways that people can get to it in the accredited investor world, but there's some pros and cons there. But just to be, really simple, we'll talk about the qualified purchaser there. So most people have heard about private equity either in a very positive context or a very bad context. They think about barbarians at the gate if they watch the movie or read the book, and that these are private equity people that are looking to just just pillage and take out the employees, and they just do a bad job and strip these companies down and make money. Okay, that's what people think of if they have a negative connotation. There are very, very few illustrations. There are a few, but there are very few illustrations over time where that actually has been the objective of a private equity firm. Most of the time, what happens is they just make a lot of money because they take a reasonable company and make it a really better company, professionalize it, and then ultimately sell it. We have one of the firms that we own. They have what's they call the path to 3x, the path to how they make 3 times their money when they acquire a company. And they take a company that is a good company, very profitable already, has a good market position, and it's really kind of either a founder-led or a smaller company, and they just don't know how to scale it. And so the private equity firm will come in, they'll acquire the company, they'll partner with the management team or bring in a new management team, depending on the objectives of the sellers, and they will then do a lot of things to increase value. Maybe they go buy other businesses that are similar, what's called a bolt-on acquisition, or they build up a company that might be doing, let's say, $20 million in cash flow at the time that they buy it. By bolting on other businesses, expanding organically, moving into new markets, rolling out new products, they all of a sudden over 5 years, they make the company worth, generating $100 million in cash flow. Well, if you grow a business from 20 million to 100 million in cash flow, you're going to sell it for a really big number. And so that's what they do. And so if they paid, overly simple, if they paid 10 times cash flow, which would be a high number for them, but just if they did, just because it makes my math simple, that's a $200 million purchase price. If they just sell it literally for the same 10 times multiple, when they're doing 100 million, it's $1 billion. But most likely, because they've now professionalized the business and gotten it to such scale, they don't sell it for 10 times. Maybe they sell it for, and again, not saying they would, but 15 times, just because the math is easy. $1.5 billion on something you paid, $200 million for. That's an enormous return. And that's without using any leverage.
Wow.
So if you borrow half of that 200 million and you put up 100 million of cash and you borrow $100 million, you pay off that $100 million and then you sell it for $1.5 billion. Well, guess what? Your $100 million is now worth $1.5 billion. That's a heck of a return just from professionalizing the business. And it's not easy. I'm not saying it's easy, but just from taking from 20 million in cash flow to 100 million in cash flow, you now have literally made 15 times your money in that illustration. That's private equity. And obviously there's a ton of flavors around that. You can have some that focus on, technology companies, some that just focused on healthcare, some that are just focused on enterprise software and nothing else, some that are focused on industrial type businesses or cyclical businesses. And so there's so many different ways to make money inside of the world of private equity. Some buy small companies, some buy middle-sized companies, some buy big companies, some buy only global businesses, some only buy domestic businesses. And so it's actually an interesting statistic. The percentage of companies in the United States that are publicly traded continues to go down dramatically.
Mm.
And a lot of the reasons are because of the regulations and things that make it hard to be a public company now, but it's so much easier to be private. So that's where private equity is by far one of the greatest employers in the United States. And it is a major impact on the worldwide economy and just really, really smart people that do a great job at what they do.
Right. I mean, it makes sense. And I don't know if you can share any large private equity deals that have happened where these public companies have been taken private and you have professionals coming in to just better operators, really bringing in outside knowledge, expertise, and giving it fresh. But maybe, are there any like famous examples that you know of over the history?
So I think that I'm trying to think of one in particular, but there's a lot over time that fit that description. How many of the audience are going to remember specifically? There was a lot of going private transactions that occurred in 10 and 11 after the global financial crisis, but not anything that really points out as a definitive. There's some major real estate assets where that occurred with, some of the hotel chains as an example that are pretty famous examples.
Hilton, I remember. I think Hilton was one of them.
Yeah, Hilton was definitely at the top of that list. Hilton was a great example because of the fact that they almost went bankrupt during the global financial crisis and then ended up being one of the best performing private equity investments of all time.
Wow.
So, most of the time, once a company is public, and it's kind of the answer to your question, once a company's been public, they typically got it all together. They may lose their mojo and not have it together, and they might go private and then get it back, but that's less common. There's a lot more common answers to where there's so many of the businesses that we think of that are really, really large businesses today, whether you talk about, Amazon or Apple or whatever, they were originally private equity or venture capital backed. And then they became, outsized winners, in the marketplace. So, specific high profile examples of kind of turnarounds, there's ones that people would probably not recognize in the audience because they're 10, 15, 20 years ago. That would be harder to probably go through. I'm just trying to think of anything off the top of my head.
Yeah, no, the visualization I have of private equity is, they parachute into a business, they really just bring it, give it new life, new expertise, really just experts in the space that could provide value and really just analyze, something that's been stale and then eventually, turn it around, which would be a phenomenal process as opposed to the S&P 500, where it's just buy and hold the business kind of keeps on.
Correct. And it's one of the strengths of private equity historically has been to come in and really add value by having a different lens.
Hmm.
When most people are in the middle of the whirlwind of their business, they see all the trees in their business.
Right.
They see everything that's happening, and they don't have the ability to step above and look at the forest and say, okay, we have another saying as a firm, it's one of our principles, find what matters,
Hmm.
find what really is going to move the needle. And so as a result of that, when private equity comes in to a business, they're able to come in and look at it from a lens that is unemotional, going back to what I said earlier, that is also, we've seen this rodeo before and we kind of know what's coming. And so they can come into the boardroom and say, okay, out of all of the priorities that you're considering, this is what's going to really matter. This is what's going to move the needle. Vista is the largest enterprise software, private equity firm in the world. They are very, very well known for what is called the Vista playbook. All they do is enterprise software. If you look at all their portfolio companies and add them together, I believe the current number is it would be the third largest software company in the world.
Wow.
Because of the fact that, they have so many different companies in different sectors, but they're all enterprise software. And what they will do is they have a playbook that they will overlay on every enterprise software company that they buy. Here's what we think are best practices for business development, for new product rollout, for expansion into different lines. What is the best compensation design? What is the best way to manage the balance sheet? Here's the best way to manage AR, accounts receivable, accounts payable, how you should manage your balance sheet, your excess liquidity, all of these other levers that by themselves may not move things that much. So, something to where a lot of people don't think about, if you have 3 pieces of your business and you can get 10% better in each of those 3, most people say, well, that's going to make me 30% more profitable. And it's not true, because the power of compounding is 10 plus the 10 plus the 10 is actually 33%. So if you're able to do 20% now, you're talking about a much bigger compounding effect on the impact. So you can just think about it from the standpoint of, if a business is running right now with a closing rate, again, staying with enterprise software, if their business development people have a closing rate of 50%, really simple, really easy math for me, and they have an average margin of 30% on the sale, and they end up generating free cash flow from each of those sales to, 15%. Well, if you can change the 15% to 16%, and you can change the 30% to 32%, and you change the 50% to 53%, you go, well, yeah, you made 6% worth of improvements. No, you didn't. You just made a massive difference in your bottom line. I don't know off the top of my head what that math would be, but it's probably like a 2 or 3x multiple on what your free cash flow is as a result of that stacking effect. So Vista knows how to do that. They've done that with multiple companies over all different sectors over different times, and it enables them to be so much more successful when they buy a company compared to the company's management team that knows maybe a little bit of that, but not exactly how to put all the pieces together. That's how Vista and other private equity firms can add so much value when they acquire a firm. Some of them just do it with very significant amounts of leverage, and they're not looking to add a lot of value. They're just buying an asset cheap, levering up the return, and then they're going to sell it. But that's not really as sustainable. It's much more cyclical. It's much more dependent on the economy, as opposed to the private equity firms, which is really what we choose to partner with, are the ones that have a definitive edge. And they just know more than other people about that space. As when it comes to enterprise software, Vista is going to be that. When you're talking about in healthcare, your OrbiMed is the largest dedicated healthcare investor in the world. They know more about healthcare than the people that are trying to be tourists and invest in that space. They have MDs, they have PhDs, all on their team. They just have that domain expertise, which gives them an edge. And that's true in other firms that we own stakes in. All they do is spin outs from large corporate entities. Others just do technology, and that's all they specialize in some cases, very specific areas of technology. So when you place all that together, and in professional sports, just focusing on professional sports, and that's all they do. So there's lots of different ways to get to the ultimate objective, But that's the thing. If it was easy, everybody would do it. And there's very few groups that have been able to show persistent returns over time. And those groups are very hard to get access to, which means somebody must have a relationship there and the ability to write a very large check in order to be able to get in the door. And that's, obviously very valuable when somebody can build a relationship or be part of a network that does that.
Christopher, very good insights. And right, fundamentally, it makes sense to have in private equity come in with, basically consultants, advisors, which most businesses, would hire on, and that capital component to be able to, accelerate things.
And that's where it's also a big advantage because of the fact that, consultants can be fantastic, but most of the time they're paid for their time, not paid based on the success that they create. Some are, but most are just based on time. Whereas when a private equity firm comes into the boardroom, they come in with a consultant's mentality, but they also come in with an owner's mentality. And so they know that what they do, what they change, what they improve is going to either increase their investment size and the return on the investment, or it's going to hurt them. And so they have a very much more significant aligned interest with the other management team, members that they're consulting with or working with to improve the value of that business or that asset, whichever the case might be.
That's great. Christopher, just in closing, thank you for sharing, just, breaking these things down, and anything you'd like to share about your firm, just best way to get in contact with you. And
so, yeah, I enjoyed it. Thank you for having me very much. The answer is, our website is cazinvestments.com, CAZ investments.com. And obviously we'd be happy to be helpful anyway. We have good resources there that are very educational, things that talk about, kind of what is the alternative investment landscape, what is a J curve, those kinds of things we didn't have time to talk about today. But so feel free to, for listeners to go to that. And if we can be helpful in any way, we will absolutely do so. So I appreciate you having me.
Awesome. Well, thanks.
All right, have a great day.
If you like this video and looking to be a better investor, subscribe to our free email newsletter where you can even join different accredited investor groups to help you learn more, network, and connect with other investors. Also, just a reminder, this video is for informational purposes only. You should not construe any information here or any other material as investment, financial, or legal advice. We recommend for you to speak to your own registered investment advisor and also legal counsel. Thanks.